Imagine Warren Buffett himself, stripped of his multi-billion-dollar fortune, starting over today with just $10,000. How would he turn that modest sum into 1 million or even $10 million? The answer might surprise you. Buffett has actually left us a hidden cheat sheet. It is a set of principles designed specifically for individual investors like you and me. These principles allow for returns virtually impossible for his vast Berkshire Hathaway today. Are you ready? This isn't just generic advice about buy good stocks and hold. No. This is a structural secret, proven by Buffett himself. It shows how to leverage the unique advantages of small capital to achieve extraordinary wealth. Picture this. It's 1999, the height of the dot-com bubble. Warren Buffett is standing before thousands of shareholders at the annual Berkshire Hathaway meeting, a veritable oracle of Omaha. Someone asks him an audacious question. How can someone make $30 billion? Buffett, with his characteristic twinkle and dry wit, doesn't talk about complex derivatives or massive buyouts. Instead, he cuts right to the heart of what's truly possible for you. He counters, if I were graduating today with $10,000, I'd focus on small companies. That single sentence, often overlooked, was pure genius. It revealed a crucial distinction. The strategy for accumulating wealth from a small base is fundamentally different from managing an already colossal fortune. For a small investor, large capital is often a hindrance, not an advantage. This is true when it comes to generating spectacular percentage returns. You see, Buffett wasn't always the multi-billionaire we know today. His highest percentage returns, often exceeding 50% annually, were actually achieved in his earliest years. This was back when he managed relatively small sums for his partnerships. This isn't theoretical. It's his own lived experience. It is a testament to the power of starting small. To truly grasp the magic here, let's visualize the dramatic effect of that 50% annual return Buffett once achieved. Imagine starting with that initial $10,000. In just 1 year, it is $15,000. After 5 years, that modest sum balloons to $75,937. Here's where the true magic of compounding kicks in. In 10 years, that $10,000 becomes over $576,000. If you can sustain that 50% rate, that initial $10,000 turns into a staggering $7.2 million in 20 years. That exponential growth, that seemingly impossible snowball effect, is the secret sauce for the small investor. It is what we are going to unlock by diving deep into Warren Buffett's blueprint. The first and perhaps most powerful principle for the individual investor is what I call the Curse of Bigness. This translates directly into your absolute structural advantage. Imagine being in charge of $1 trillion sovereign wealth fund, or a massive hedge fund managing hundreds of billions. Your job is to deploy capital efficiently. Imagine you've identified a fantastic, well-managed company with superb products and a strong market position. However, it only has a market capitalization of, say, $500 million. For you, with $1 trillion to invest, even putting $100 million into that company would be a massive undertaking. $100 million represents only 0.01% of your fund. It is barely a rounding error. More importantly, trying to acquire $100 million worth of stock in a $500 million company would immediately cause the stock price to skyrocket. This makes your average purchase price far too high. The very act of buying would destroy the undervaluation you identified. Furthermore, owning 20% of a public company often triggers regulatory hurdles. It makes it incredibly difficult to exit your position later without collapsing the stock price. These massive funds cannot practically invest meaningfully in truly small, undervalued companies. They simply cannot get enough skin in the game to make a difference to their overall returns. They run into immediate liquidity and pricing problems. This institutional disadvantage forces large funds into a very specific type of investment: already large, widely followed companies. Think about the Apples, the Amazons, the Microsofts, the ExxonMobils of the world. These are colossal businesses, excellent in their own right, but they are also scrutinized by thousands of analysts. Their prices are usually efficient, meaning they already reflect their known value. Finding significant undervaluation in such megacaps is exceedingly rare. Large institutions are often compelled to pay market or even premium prices for these companies. This inherently limits their potential for outsized, percentage-based returns. They might make billions in absolute dollars, but their percentage gains are often modest, reflecting the broader market. Now, here is your absolute structural advantage as an individual investor. Operating with $10,000 or $100,000 or even $1 million, you can acquire significant stakes in excellent, smaller companies. This is possible without impacting the share price one iota. You can shop in a market that remains invisible or inaccessible to the giants. You can quietly accumulate shares in a $20 million market cap company or a $50 million market cap company. These companies have strong fundamentals, but are completely off Wall Street's radar. Nobody is covering it. No large fund can touch it. Therefore, it often trades at a significant discount to its intrinsic value. You are playing on a different field with different rules. In this specific game, smaller is unequivocally better. Buffett's own history is littered with examples of this. Think about his early acquisitions like Nebraska Furniture Mart or See's Candies. These were not publicly traded tech giants. Nebraska Furniture Mart was a privately held furniture store, albeit a very successful one. See's Candies was a regional confectioner. They were fantastic businesses with strong brands and excellent economics. But they were small relative to the scale Buffett eventually operated at. Wall Street simply ignored them because they were too small to move the needle for big money. Buffett, operating with smaller partnerships, was able to acquire them whole or significant stakes. He leveraged their excellent fundamentals to generate massive returns. He wasn't competing with other large funds. He was finding gems in a market that was too inefficient for them to bother with. This is the market you, the individual investor, can still access today. This brings us to principle 2, the circle of competence. Buffett often quips that the secret to his success isn't being a genius across all fields. It is, rather, knowing the boundaries of his intelligence. He defines his circle of competence as investing only in businesses and industries he deeply understands. He is famously quoted as saying, "I'm no genius. I'm smart in spots, but I stay around those spots." This isn't about being smart in every industry. It's about being acutely aware of what you know, and more importantly, what you don't know. Then it is sticking rigorously to the former. To illustrate with a real-world analogy, imagine a seasoned chef who has spent decades mastering Italian cuisine. They understand every ingredient, every technique, the nuances of customer preference, the dynamics of suppliers. They also know how to run a profitable restaurant in that specific niche. Now, would that chef suddenly decide to open a complex biomedical engineering firm? Or perhaps dabble in quantum computing? Of course not. Their expertise, their superpower, lies within their circle of competence, Italian food. Similarly, as an investor, your professional background, your personal interests, or even a deeply cultivated hobby can be your investment superpower. If you work in a specific industry, say healthcare, manufacturing, or software, you likely have an insider's understanding of its competitive dynamics, its key players, its regulatory environment, and its future trends. This intrinsic knowledge gives you an immense edge over generalist investors who are merely skimming headlines. Buffett's discipline in adhering to his circle of competence is legendary. Recall the dot-com bubble of the late 1990s. The market was gripped by a frenzy for internet and technology stocks. Traditional value investors, including Buffett, were widely criticized for being old-fashioned, for missing out on the new economy. Everyone, it seemed, was making a fortune in tech. Yet Buffett steadfastly refused to invest in these companies. Why? Not because he thought they were inherently bad businesses. Instead, he admitted he did not understand how to value them. He couldn't reliably project their future cash flows. He couldn't identify their sustainable competitive advantages in a rapidly changing landscape. His adherence to his circle of competence protected his capital when the bubble inevitably burst. This demonstrated the immense power of discipline over hype and common sense over popular opinion. While others lost fortunes, Buffett's capital was preserved. It was ready to be deployed when opportunities arose in areas he did understand. This deep understanding also acts as a critical emotional shield. Investing is not just an intellectual exercise. It is a profound test of temperament. Market volatility is not a possibility, it is an absolute certainty. Buffett famously warns investors to expect their holdings to drop by 50% at some point. If a stock you own, one you truly comprehend inside and out, drops by 50%, your conviction based on fundamental knowledge prevents panic selling. You know why you bought it, you understand its long-term prospects, you can differentiate between a temporary market fluctuation and a permanent deterioration of the business. This conviction allows you to hold through downturns, or even better, to average down and buy more at a discounted price. Selling in fear locks in a permanent loss. Without that deep understanding, the emotional impulse to flee when prices fall becomes almost irresistible. Moving to our third principle, and one Buffett considers the eighth wonder of the world, the power of compounding. This means start early, stay invested. Buffett's most famous analogy for compounding is that of a snowball. He describes it as getting a good start on a very, very long hill. A small snowball rolled down a long hill gathers far more mass than a large snowball rolled down a short one. The key here isn't just the size of the initial snowball, it's the length of the hill, or, in investing terms, time. Time, not just size, is the ultimate multiplier. Buffett's own trajectory is the most compelling testament to this. He started investing at age 11. While he achieved impressive percentage returns in his earlier years, the vast majority of his immense wealth was accumulated after age 65. Think about that for a moment. He was already a very rich man at 65. But his wealth truly exploded in his 70s, 80s, and 90s. This powerfully demonstrates the exponential, backloaded nature of compounding returns over decades. The early years feel painstakingly slow. Your $10,000 growing to $11,000, then $12,100 doesn't seem dramatic. But those initial increments are laying the invisible foundation for the explosive growth that comes much, much later. This happens as the base capital itself becomes substantial. Most people give up or get impatient before they reach the truly exponential part of the compounding curve. For compounding to work its magic, two pillars are absolutely critical. The first is avoiding permanent capital loss. This is Buffett's concept of a margin of safety. The critical importance of buying assets for significantly less than their estimated intrinsic value. If you estimate a company is truly worth $100 per share, you aim to buy it for $60 or $70. This 40% or 30% discount is your margin of safety. It acts as a buffer against unforeseen problems, against economic downturns, against your own misjudgments, or against temporary setbacks for the business. If something unexpected happens, and the company's value proves to be only $80 instead of $100, you still break even. You might even make a small profit because you bought it at $60. This buffer ensures that your snowball doesn't melt, doesn't get chipped away, and can continue to roll and gather mass uninterrupted. Without a margin of safety, you are exposed to significant downside. This can derail the entire compounding process through permanent capital impairment. The second pillar, equally important, is emotional fortitude. Stay in the game. Compounding requires uninterrupted growth. It demands that you resist emotional impulses during periods of market volatility. Market crashes, corrections, and panics are inevitable. Buffett famously warns against using stop-loss orders. He sees them as a mechanism for panic selling rather than intelligent risk management. When the market is in turmoil, when headlines are screaming doom and gloom, the natural human impulse is to sell, to flee, to protect what little capital you have left. But this is precisely when the greatest damage to compounding occurs. Panic selling during crashes, like the global financial crisis of 2008 or the pandemic-induced crash of 2020, liquidates the compounding effect. Investors who sell in fear convert temporary paper losses into permanent, real losses. Critically, they miss the subsequent, often rapid, recoveries. They reset their compounding clock back to zero, or even into the negative. This forces them to start all over again from a smaller base. To truly benefit from compounding, you must cultivate the temperament to sit through these storms. You must trust your fundamental analysis and remain invested, allowing time to do its heavy lifting. Remember Buffett's timeless advice: be fearful when others are greedy, and greedy when others are fearful. This emotional discipline, the ability to act counter-cyclically and to withstand short-term pain for long-term gain, remains the hardest part of the entire wealth-building equation. Now, let's bring these timeless principles into the 21st century and apply them to your journey today. A crucial insight comes from Buffett's longtime partner, Charlie Munger. He often spoke about what he called the first $100,000 hurdle. Munger posited that for most people, the toughest challenge, the true test of discipline and financial acumen, is accumulating that initial seed capital. Before you reach this threshold, the raw, unadulterated power of compounding, while mathematically present, is barely perceptible in your everyday life. Consider the math. 10% on $10,000 is a gain of $1,000. That's nice, but it won't change your lifestyle. However, 10% on $100,000 is $10,000. Suddenly, the absolute dollar return becomes far more impactful as your base grows. This difference is not just numerical, it's psychological. Crossing that $100,000 mark provides a tangible sense of momentum. It is a visible demonstration that your hard work and discipline are truly paying off. This is where the snowball, having been painstakingly packed and gently rolled, finally starts to gather noticeable size. Munger offered 4 key habits for building this foundational sum. He emphasized that it is built through hard work, not primarily sophisticated trading. First, rational thinking. This means cutting through the noise and hype. Second, extreme proactivity. Always look for opportunities to learn, to earn, to improve. Third, recognizing opportunities. Be alert to mispriced assets or exceptional businesses, even if small. And critically, fourth, consistently spending less than you earn. This habit is the bedrock. This foundational capital, that critical first $100,000, is primarily built through relentless discipline, diligent saving, and purposeful labor. The worst-case scenario for a small investor is to neglect this initial accumulation phase. Constantly churning capital or spending too much never allows the compounding engine to even start. The best case is diligently building that base. Once you have it, the engine finally has enough fuel to run powerfully. So with that initial capital, how does Buffett advise us to select stocks in 2026? He outlines 3 clear criteria. First, is it a good business? What Buffett means by good is a business with a durable economic moat. Forget about fleeting trends or hyped up concepts. We are looking for companies that possess sustainable competitive advantages. These are barriers that protect their profits from rivals. In today's market, these moats can manifest in several ways. Strong brand power, like a Coca-Cola that commands premium pricing. Powerful network effects, where the value of a product increases with each new user, such as Microsoft Office or Google. Significant cost advantages, where a company can produce goods or services far more efficiently than competitors, or high switching costs for customers, making it expensive or inconvenient to move to a competitor's offering, common in specialized software or industrial supplies. For the individual investor, the true hunt for these moats lies not in the mega cap, widely covered stocks. It lies in smaller, niche, or regional companies. These are the businesses with strong, durable moats that are still flying under the radar of large institutions. Investors should look for specialized industrial components manufacturers, unique consumer product brands with loyal followings, or local essential service providers that dominate their specific geographic area. These are often businesses with high returns on capital and consistent cash flow generation. Yet they are ignored by Wall Street because their market cap is too small to justify institutional research. Second, is it led by good management? Since direct access to CEOs and boards is unlikely for most individual investors, we must rely on proxies for assessing management quality. Investors should consider several signals: high insider ownership, which aligns management's incentives with those of shareholders; consistently shareholder-friendly policies, evident in transparent reporting, reasonable executive compensation, and sensible capital allocation decisions. For instance, are they reinvesting wisely? Are they paying down debt? Are they buying back shares at attractive prices rather than issuing more to dilute shareholders? Also, look for a history of conservative accounting practices, avoiding aggressive financial engineering that can obscure true business performance. Investors should actively avoid companies with management teams that have a track record of excessive debt, opaque financial statements, or a history of shareholder dilution. Third, is it available at an attractive price? Buffett's timeless maxim bears repeating: price is what you pay, value is what you get. Even the best business, led by the best management, can be a poor investment if bought too expensively. The margin of safety, our buffer against error, comes from paying less than intrinsic value. For valuation, investors might explore fundamental metrics like the price-to-earnings ratio and the price-to-book ratio as starting points. It's crucial to compare these ratios to industry peers and the company's own historical averages. However, these quantitative metrics must always be combined with a qualitative assessment of earnings quality and business durability. A low PE ratio on a declining business is not a bargain. A high PE ratio on a rapidly growing business with a strong moat might be justified. The nuance of the 2026 market is that while small cap opportunities certainly exist, the proliferation of index funds and exchange-traded funds, such as those tracking the Russell 2000, means that even smaller companies can receive some mechanical capital. This implies that truly deep value, or completely abandoned gems, require more diligent first principles research than in Buffett's earliest, less efficient days. Navigating today's market also comes with modern risks. A significant one is underestimating the journey. Buffett's 80-plus years of experience are irreplaceable. It's vital to start small, gain practical experience, and cultivate a deep sense of humility. The market is a demanding teacher, and overconfidence is its most expensive lesson. The evolving market structure also means the, quote, data advantage that Buffett might have once had is largely gone. Public financial information is abundant, easily accessible through SEC filings and analyst reports. The true edge now comes not from having more data, but from superior interpretation of that information and unwavering long-term conviction in your analyses. Finally, the emotional trap is arguably stronger today than ever before. Modern trading apps, with their instant execution and gamified interfaces, make frequent, impulsive trading incredibly easy. This often hinders compounding more than any other factor. Investors are constantly tempted to react to every headline, every market swing, every hot tip. Buffett's timeless maxim remains true: be fearful when others are greedy, and greedy when others are fearful. This emotional discipline, the ability to act counter-cyclically and to withstand short-term pain for long-term gain, remains the hardest part of the entire wealth-building equation.
It's important to remember Buffett's default recommendation.
For the vast majority of investors who cannot or choose not to dedicate themselves to this deep, fundamental research, he has provided clear guidance. In his will, he advises his wife to put 90% of her inheritance into a low-cost S&P 500 index fund. This is a powerful, humble acknowledgement from the greatest investor of all time. It shows that beating the market through individual stock selection is exceptionally difficult and time-consuming for most people. Ultimately, the journey of turning $10,000 into $1 million or even $10 million isn't about the size of your money to begin with. It's fundamentally about the size of your mindset, the depth of your patience, and the unwavering strength of your discipline. You, the individual investor, possess powerful structural advantages that even the wealthiest institutions can never replicate. You have the agility to identify truly great small companies. You can partner with them patiently by owning their shares. Then, you let the quiet, persistent magic of compounding work its generational wonders over time. Warren Buffett may be retired from the day-to-day investing game, but his timeless principles, understanding a business thoroughly, identifying strong economic moats, seeking out excellent aligned management, buying assets with a significant margin of safety, and critically, letting time do the heavy lifting, remain the most potent blueprint for building serious, lasting wealth in 2026 and far beyond. Embrace these lessons, and you equip yourself with the tools for your own extraordinary financial future.